Welcome to our group assignment. Today we will be discussing our IPO valuation for Iceland Foods Limited. We will begin by discussing the current state and value of the company and then determine the share price alongside an estimation for the equity to be raised for the company. We will start by looking at the current state of the markets of the grocery store industry, and we will see where Iceland Foods stands in comparison to its competitors. Using the graph, we can deduce that Iceland has a fairly small market share of just 2%. The EV/EBITDA is a lot higher than the competitors because we still haven't reinvested the raised equity in the company, therefore it's a short-term figure. The debt-to-equity ratio is similar to the closest public competitors. The EV/EBITDA ratio is a metric that we use to value the company, debt included, to the company's cash earnings and less non-cash expenses. The debt-to-equity ratio is the metric we use to evaluate Iceland's financial leverage and is found by simply dividing the company's total liabilities by its shareholder equity. As seen from the graph, our debt-to-equity ratio for Iceland is higher than that of Tesco's and Sainsbury's. We believe that Iceland would benefit from an IPO in various ways. Firstly, it would spread awareness, as well as add brand value. It would also increase the capital in the company, and allow for expansion to hopefully result in an increase in market share for Iceland. The direct competitors are already publicly traded, which has given way to them capturing a significant portion of the market share. Therefore, we think that Iceland should go through the IPO process and list itself publicly. The method we use to value the company is the discounted cash flow model. This is the market standard approach to valuing a company using the concept of time value of money and predicted future cash flows. Using the DCF model, we can conclude that the firm has an enterprise value of £3.8 billion. This valuation is based on using the previous 3 years and is also under the assumption that the conditions will remain steady for the following years. For our growth rate, we assume that the company would grow at a slower 1.5% per annum rather than the current UK economy, which is growing at 2.31%. The primary reason for this assumption is due to the global pandemic, COVID-19. Both the growth rate and the weighted average cost of capital are key factors in determining the company's terminal value, which is the value of an asset, business, or project beyond the forecasted period when future cash flows can be estimated. Next, we will determine the IPO offering price, as well as the returns and changes we can expect to see once the process has completed. Subtracting the net debt from the enterprise value, we will arrive at our total equity value of the firm. We then use this figure to determine the value per share, which, as we can see from the presentation, is £50.20. The next step was to decide the total equity to be raised. We suggest that the firm should raise £630 million through the issuing of new shares, to bring down the debt-to-equity ratio closer to the market average of 1.94. The price the underwriters get the shares at would be £48.40 before we list the shares at an opening price of £50.20. This would cover our underwriting fee of 10% once the shares go on the open market. There was no need to underprice this share due to the fact that the share price of £50.20 is already a relatively attractive price for investors given the value of the firm in comparison to its direct competitors. Next, we estimated the expected return for our IPO using two methods. The first method was using the arbitrage pricing model, which makes use of the arbitrage pricing theory to predict assets return while also taking into consideration the systematic risk which resulted in us getting an expected return of 34%. The second method is using the CAPM, or the capital asset pricing model, which uses the current UK risk-free rate of 0.86%, as well as the beta of the company, which we ended up getting as 1.447, which was derived from using the average of the peer group, and in an efficient market to determine the expected return of 6%. The IPO process is an 8-step procedure which usually takes 9 to 12 months. A detailed description of each step can be seen using the diagram on the slide. When determining our equity to be raised value, we used a range of 100 million to arrive at the amount to be raised, starting at 550 million, going all the way up to 650 million. The table shows how the different equity to raise values will affect the debt to equity ratio, and therefore the price of the share. Using the trade-off theory, we determined that adding 630 million in equity would be the appropriate amount, as this would reduce the debt to equity ratio to be more akin to the industry average. Adding equity would also reduce the risk factor of bankruptcy. So in conclusion, we strongly believe that Iceland should go through the IPO process and start trading publicly, as this would give them many benefits as discussed in the presentation. Adding equity capital to the firm would help expansion and mitigate the negative effects that the global pandemic has had on the market. Referring to the slides before, although there is a price range, we believe that the price we chose would be the most appropriate. Raising equity in the company would also lower the leverage ratio, therefore reducing risk of bankruptcy and allowing the debt to equity ratio to be more fitting to the supermarket industry average. For the investor's return, we will be using the expected return of 6% as our estimation due to the fact that this is a more realistic figure than the number we received as a result of the APT.